Hello and welcome to Financial Intelligence. In this video, I want to talk about target date funds and their drawbacks. 401k plan providers usually use target date funds as the default option for 401k investors. Since many people never change their pre-selected plans, target date funds have become the most prevailing investment vehicles in 401k accounts. So if you have a 401k account and you haven't changed your default investment plan, you are most likely investing in target date funds. In this video, I'm going to share with you 3 drawbacks of target date funds. If you like the type of content that I provide on this channel, subscribe to the channel and give this video a thumbs up, and also hit the notification bell so that you don't miss any of my future videos. Target date funds are mutual funds or exchange traded funds, or ETFs for short, that are structured to grow assets for individuals who plan to retire at a specific time in the future, hence the name target date. For example, if you are planning to retire in 2040, you could invest in 2040 target date funds, which are designed to meet the capital needs of investors who want to retire in that year. To give you an idea of how assets are allocated among different asset classes in target date funds, I've decided to show you Vanguard's 2040 target date funds asset composition. I'm using Vanguard's target date fund as an example, but almost all target date funds follow a very similar investment strategy. Therefore, you can easily extend the conclusions I made here to the target date funds managed by other financial institutions as well. This chart shows you the types of different asset classes included in Vanguard's 2040 target date fund. As you can see, investments in total stock market index account for 48.6% of assets, followed by 32.9% exposure to total international stock index, and the rest of the fund consists of various types of bonds, including US and international bonds. Here are the 3 reasons why I think this type of asset allocations is problematic. Reason number 1, exposure to US bonds. The number 1 reason that I don't like target date funds is that they have a large amount of exposure to US bonds. US bonds are debt securities issued by the US government to finance its operations. In other words, when you are investing in US bonds, you are lending money to the US government, and in return you get interest payments. However, the issue is that these interest payments are very low at the moment, and as a result, your return on investment in US bonds is going to be super low. Additionally, if you take into account the impact of inflation, you will notice that US bonds offer 0 to negative yields, meaning that you actually lose money when you invest in US bonds. That is because the interest payments paid by the US bonds are actually smaller than the inflation rate that erodes the value of your initial investment. I have created another video where I explain this phenomena in more detail. I will add the link to that video here so that you can check it out. Looking at this pie chart, Vanguard's target date fund has almost 18% exposure to combined US and international bonds, which is too much. Note that international bonds are also in the same ballpark as the US bonds in terms of their performance. Therefore, when you are investing in Vanguard's target date funds, 18% of your assets are actually very likely to lose value over time. Reason number 2, exposure to international companies. The second reason that I don't like target date funds is because of their large exposure to international markets. International markets are known for their higher volatility and less stability, which are driven by geopolitical reasons. It is true that when you are investing in international stock markets, you are increasing your portfolio's diversification. However, you are also taking on a large amount of risk. This is in contrast to a more traditional approach to investment, which is to focus on US stocks only. When investing in US stocks only, you are limiting your diversification, but at the same time you are reducing the amount of risk that you are exposing yourself to. Investing money in emerging economies is not the best plan if you are saving money for your retirement. In my opinion, the amount of risk that you are assuming by investing in international markets is much larger than the benefits of extra diversification that this strategy provides. In summary, your risk-return profile is going to be much better if you focus on more stable companies which are active in more stable countries such as the US. Vanguard's target date fund has almost 33% exposure to international markets, which is also too much. Reason number 3, exposure to small cap US companies. Finally, the asset with the largest share in Vanguard's target date fund is Total Stock Market Index. This index includes all types of companies in the US stock market regardless of their size. In other words, this fund gives you exposure to the total US stock market, which includes both smaller, less established companies as well as larger, more established S&P 500 companies. From a historical perspective, if you are investing for your retirement, it is always less risky to invest in large cap established companies such as the ones listed on the S&P 500. These companies tend to have solid balance sheets, which means that they can handle tougher economic environments with more resilience than their smaller competitors. Larger companies have particularly outperformed smaller companies during inflationary periods. Therefore, if inflation is of concern to you, you should consider investing in funds that track larger cap companies. I hope that you liked this video. If you have any suggestion or recommendation, please add them in the comment section below. Don't forget to subscribe and like this video, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.